Hi everyone, it's Sean from STK Markets here today. I've got Dr Manny Pohl, Senior Fund Manager from ECP, here today talking about how the market's performed. We've been following Manny for quite a few years. He's continued to outperform, which has been fantastic, growth orientated. We've just had a high inflationary environment with interest rates going up, and we've seen the portfolio again outperform the market into the growth phase. That's almost unheard of. So, Manny, welcome today. Thank you for your time. Can you give us a bit of update of how you see the markets and what's going on?
Well, yeah, I mean, we were talking earlier about the confusing signals that are out there. And who would have thought in this current environment, like you said, with interest rates going up? But I think there's two parts to that. One is that the central banks are clearly focused on getting inflation down. And those of us who are in the markets and analyze companies, inflation this time round was very different to what it has been in the previous part. It was driven by the whole knock-on effect from the COVID environment and also the war in Ukraine. And specific commodities just were not delivered to the market. So it wasn't that the consumer went out and was spending crazily and buying everything up and pricing everything up. There was a severe shortage of a number of things around the planet, and clearly a mismatch between supply and demand. So we're seeing those supply chains start to be put back into place again. Smart management, sourcing product elsewhere where they can. So these pressures are alleviating. And in the same instance, the central banks have treated this like any other inflationary spike and adopted monetary policy that's putting the squeeze on everybody. Those of us that were looking at it said, listen, both of those are going to have the effect of bringing down the inflation rate, but obviously cooling everything. And the central banks are going to have to relax it sooner rather than later. And in this whole environment, growth companies are still performing because they have the ability to do that. They've got a product that consumers want. They're not forced to buy, not forced to, but the cost of doing businesses have not been increasing like other people and other commodities. So they have a really sustainable competitive advantage, which enable them to continue to grow earnings. But the multiples were under pressure because of this whole interest rate fiasco that was going on. So if you have the interest rate either flattening or even coming down, you then have the true earnings of these companies coming to the fore in the valuation. And that's what's been happening. People have decided that this interest rate pattern is not going to continue. So let's look at the earnings. And the growth companies are the ones that have been delivering the earnings because that's by definition what they are. And that's coming through the valuations in the marketplace.
Okay, so that reduction in interest rates with your particular portfolio where you're focused on growth stocks, do you see your portfolio continuing outperformance with what you're predicting at the moment?
Oh, I have no doubt of that, Sean. I mean, you guys will see, the top 10 holdings because we publish that every quarter. We haven't published the July numbers yet, but on the basis of what you know is in the portfolio, Blind Freddy can go and see how those stocks have done. And certainly one would expect that July would be reasonable, and we have nothing to suggest as we get into reporting season that the results are going to be any worse. In fact, we're thinking that in some instances they're going to be better. So no, I mean, we've had a really good run, and sometimes you over-earn. But in terms of the earnings that are coming through, we're really confident that that's going to continue.
Fantastic. So very, very positive outlook there from Manny today.
Yeah.
What we've got at the moment, or what you have at the moment, is a convertible note against the Flagship investments portfolio.
Yeah.
They look like a good deal. Face value of $2.70 versus the last trade at $2.60, paying around 5.5% per annum. Can you just go a little bit more into why you've done this and what's the ultimate game there?
Yeah, Sean, the ultimate game was we needed to expand the company Flagships. And given where interest rates were at the time, it made sense for us to go and issue a convertible note because interest rates were down. If you wanted to issue equity, it was reasonably expensive at that point from where we were sitting. So for us, it was a no-brainer. And that was evidenced by the fact that when we went to raise the money, we got it in 2 days. I mean, there was just demand just came at us. So clearly the product was priced right. And there was a lot of demand out there from people that were looking for some form of yield. Now, one has to be concerned when you have convertible notes because invariably you have a company that's either got other borrowings or maybe its business is a bit shaky. You never know what is going to ensure that the interest can be paid. In this case, the portfolio is well disclosed, and they're quality growth companies. And it's a portfolio of companies, and not just one business that's digging a hole or selling some whiz-bang, some gadget. So you've got a portfolio of quality companies that are backing this. There was no gearing in the company whatsoever. And for me, that was evidenced by the fact that investors came into it really quickly. As you said, it's yielding 5.5%, and it's currently trading at a discount. But in 2 years' time, that ratchets up to 6.5%. So there is no question that the assets are there to back it if people want their money back at the end of the period. And in the meantime, if we continue to perform, like I just said, where I'm really positive, then you can convert into equities, and you do that into quality growth companies that are a 20-30% discount to the value in the market. So for me, it's just a non-brainer. It's a no-brainer at all.
That sounds really good. Listen, Manny, is there anything else you want to say about the markets before we get off? I know you're going to an appointment after this, so you don't have much time because you're always busy. But is there anything that you want to say to your investors at the moment?
Oh, look, I have no doubt that if you are into quality equities that are well researched and have got a fundamental business that's got a sustainable competitive advantage, there's no better place to put your money. And I know that people are looking for yield, and especially the LICs. They trade at a big discount to the market. So if you're looking to get into the market at a lovely discount, the LICs are the place to be, especially if you're a long-term investor, because then you're not looking to sell it. You're looking for the ongoing dividends that it pays, and obviously looking for share price appreciation over the period. And if you get in at a discount like it is now, well, hallelujah.
Well, I'd have to agree with that. You've had these funds going since 1998. That's a 25-year track record. So if you're looking at historically how you've outperformed and how you've gone, I mean, it's a pretty good investment, historically speaking.
Well, and I insist that all the people in our business, they put their money into the products that we have, and my equity investments are in Flagships. So yeah, I put my money where my mouth is, and I'm really happy with what I've managed to do with the money.
Congratulations. Thanks for your time, Manny.
Thanks, Sean. Thanks for your time, and good luck with everything that you're trying to do.
Thank you.